All right, my heroes, we're back. It's time to talk about volatility now. Everything that we've talked about throughout this course, throughout the Market Hero course thus far, has built off one another. Volatility is no different than that. Volatility, just gonna get it out there right away so we can move on with our lives, is not what you think. The volatility that is spoken about on CNBC, on Bloomberg, on Yahoo Finance, Investors Business Daily, all of it is a complete farce. I'm just here to say that straight up. It's a complete farce. Volatility is absolutely not what you think it is. It's not what you think it is. However, understanding what volatility really is where our edge as traders is, which is really, really exciting. So not only throughout this lesson and throughout this little section here are we going to completely blow the doors off of what volatility actually is, but how to show you exactly how to take advantage of what it really is, which is really, really cool. So seriously, I don't really like to over exaggerate things, but this is really going to change you. Market Hero just in itself is going to change you guys, but this specific lesson on volatility is where it starts to get really, really nasty. Whatever you knew about the stock market ahead of time is going to change. I'm just telling you, it's going to change. It will change for the better, but no matter what, whether you're a 20-year veteran or you don't have an account, this lesson will change you. There is no question about that. This lesson on volatility will absolutely change you. So the way I think of learning about what volatility is, so you guys remember the Matrix, where Morpheus spends all this time finding this guy named Neo because he thinks he's the one. And finally he gets him, and he gets him in a room and goes, look, I'm going to give you two options. You take the red pill and you take, I don't know if it was the red pill or the blue pill, but he's like, you take the red pill and you'll go back to life. It'll be like you never ever spoken to me ever again. However, you take the blue pill, I'm going to show you just how deep that rabbit hole actually is. Volatility in terms of the stock market, making money in the stock market and ultimately becoming a market hero is absolutely like just going down that rabbit hole. There is no question about it. It's just like going down that rabbit hole. Um, so beware. Anything that you ever knew about the stock market, about volatility, is over. Is over. And it changes starting now. So what is volatility? Now, the volatility that we're used to hearing about on a day-to-day typically is price fluctuation. That's what's known in conventional wisdom and the typical financial media as volatility. One day stocks are up, one day stocks are down. That, according to these so-called experts, and again, conventional wisdom, is called volatility. Right? So there's an index out there known as the fear index that people like the VIX, which is called the fear index, that people like to associate with the term volatility. The thought is the higher the VIX or the higher the volatility index, the more fear there is out there, right? So the VIX, the way the VIX is priced is it takes SPX, which are S&P 500 index options, and it goes all the way out on the put side. And it goes all the way out on the put side, and it says, how far do we go until there are no more bids? And once it finds the strike where there are no more bids, it takes into account a couple of things, puts together an algorithm, and it comes out with the price of the VIX. Again, conventional wisdom, typical financial media, is just using the VIX as a way to gauge quote unquote, I wish you could see me right now, but I'm doing the quote unquotes in my hands, quote unquote fear. That is not what volatility is. It's not even close. Volatility can be described in 7 words. In 7 words. Are you ready? Volatility is the 1-year expected move. That is it. So we've done a lot so far up to this point with the normal distribution curve and how 68.2% of random occurrences, stock prices and price movements are random occurrences, fall within the expected move or 1 standard deviation. All right, we showed you exactly based off of delta how to find what the expected move is going to 16 delta on each side, right? Because that's one side of a standard deviation, right? So we showed you all those things. And now the truth is it all comes back to volatility. So those 16 delta options that are the expected move up or down are derived from volatility. That is really, really cool. And the truth is this VIX that, again, everyone is freaking out about, or this VIX that everyone's freaking out about that they're calling the fear index is just the 1 year expected move in the S&P 500. So get this straight. If the VIX is at 20, what the market is currently saying is the following. If the VIX is at 20, the market is currently predicting the S&P 500 in the next calendar year to go up or down 20%. That's it. That's it. What the hell does that have to do with fear or greed or anything else? Remember, these markets are super, super liquid. Remember, we talked about this before. We talked about liquidity, how it's so, so important. And the more liquid a product is, the more the probabilities that we're getting off of things like delta are more accurate. The VIX is a super liquid product. Millions of contracts traded today. And the S&P 500 is the most sought after index in the world, right? So these numbers that are based off of that are dead ass accurate. If the VIX is at 20 and people thought the market was going to go up 30% in the year, they can move the price if they want. They have that, or they can make bets that it's wrong. That's why it's so beautiful. It's a two-sided market that's incredibly liquid, that's going to be able to give this prediction out there. So again, volatility, all it is, it's not prices going up or down. It's not fear and greed. All volatility is the 1 year expected move. That's it. And specifically the VIX, which up until right now you knew was the fear index. Now it's not that anymore. But the VIX, all the VIX is, guys, all the VIX is the 1 year expected move in the S&P 500. So if the VIX is 10, the market is collectively agreeing on the following. We believe that the S&P 500 in the next calendar year is going to go up or down 10%. If the VIX is at 50, which we haven't seen in a very long time, not since 2008. Actually, I think the VIX got up to 80 in 2008. But if the VIX is at 50, the market would currently be saying, okay, guys, we believe, and again, this is trillions and trillions of dollars in the most liquid products agreeing on this, that the market can go up or down 50% in the next year. And then the example that I just used with the VIX at 80, back in 2008 when it was ugly, the 1 year projected move with a VIX at 80 was 80%. I'll do you one better. Here's the algorithm. It's funny, people use like these algorithms like they're going to be like this craziest thing ever, but they're not. This is so simple. It's like this little math equation. So you take the price, right? In this case, the S&P 500. You multiply it by the volatility, by implied volatility. Implied volatility is just the VIX. And then you multiply the square root of how many days out you'd like to see over 365. Right? So that's all it is. That is all it is. So let's go over to my little Google sheet that I have here, and we're going to go ahead and do some of this stuff. Right? So remember, what we're looking for is price times implied volatility, or we could just call it volatility for now, just for ease. And we're going to multiply that by the square root of days over 365. Right, so there's a couple inputs we're going to want to have here. Right, so the first is price. If you have Gmail, you get Google Sheets just off the bat. Right, and there's some really interesting things, and we have them later on in this course that you'll be able to download and use for you. But there's some really interesting things where you can just like kind of drag and drag and get stock prices and get stuff like that. So the way to do that is we go equals Google Finance, and then now it's looking for like certain things, for example. So the ticker we want is the ticker for the S&P 500, right? So the ticker for the S&P 500 is just SPX. I think we have to do this in quotes. Great. And then the attribute we want is price. Let's see if that works. No, I think I need to do double quotes here. There we go. Now it's looking a little better. Loading, great. So now we've gotten the current price as we stand here today, Saturday at 6 o'clock or 5:59. That's where we stand today. So this is the price of the S&P 500. So what I'm going to do is I'm going to just move this over here, and I'm going to say this is price, right? And now we want the volatility, right? So what did we just find out what volatility is? Volatility is just the 1-year expected move in the S&P 500, and the VIX is volatility or the 1-year expected move on the S&P 500. So we want to get, so volatility here, I don't know if I'm spelling all this right. No, I'm not, but you know, what else is new? Volatility, all we need to do is Google Finance equals VIX and price. Great. So the VIX right now is at 15.51. Stop right there. As we stand today, with the data we have in front of us today, what is the 1-year expected move in the S&P 500? You don't need anything else. In fact, you don't even need this line. You don't even need this. This is the VIX as of right now. See this? We're getting the VIX, and we're getting the current price. Right? What is the VIX? The VIX is the 1-year expected move on the S&P 500. What is the 1-year expected move on the S&P 500 as it stands today? It's 15.51%. That is it. That's some really cool shit, guys. That stuff gets me really, really excited. That is one of the reasons why you guys are being market heroes. Just wait for what I have in store for you for next. It's going to be absolutely wild. I know I'm slurring my words because I'm so excited about this thing, but this is some mind-blowing stuff. Let me go back to this real quick because it's so damn important. What is volatility? Volatility is the 1-year expected move. That's it. It's not the fear index. It's not prices moving up and down. It's none of that garbage. And the VIX itself is not the fear index. It's just a 1-year expected move in the S&P 500. That's all it is. Right? So let's get the price back again. So we want to go equals Google Finance, and then we're in double quotes, we want the SPX, and that's just a symbol for the S&P 500, and then we want the price attribute. Now there's a ton of other stuff you can get in here, right? And let's say days is how many days? So let's say in the next 30 days, we want to find out how far the market can move up or down. This is all the data we need right here, which is like really, really cool. So the way you do some sort of a function in Google Sheets is to start with an equal sign, and then you can kind of like click around and drag and all that stuff. So what we want to do is pretty simple. So we can just click on this, so that's B3, and what we want to do is times volatility. Now, the one thing is volatility is a percentage, right, of 100. So 15.51 is really 0.1551%. So what we want to do is this divided by 100, right? That's all it is. So if we take 15.51 divided by 100, we're getting that 0.1551. So that's all we're really looking for there. So we have price B1 times volatility, which is B4 times the square root of days over 365. So here we go. We go times square root, does it for us. Nice, because I want to know how the hell to do that. We have days here. Excuse me. We have days over 365. And there you have it, folks. So the expected move in the S&P 500 in the next 30 days, based off of where the expected move is in the S&P 500 over the course of the next year, which is just the VIX, is $108. So what is that in terms of percentage? Let's do equals this divided by this times 100, right? So before everyone in the world starts freaking out about, oh my God, the market can move this much up, the market can move this much down, oh my God, there are trillions and trillions and trillions of dollars betting on certain things, right? Volatility and the VIX are based off of XPX and S&P 500 options. Those are the most liquid, high trillions of dollars every single day are bet on those. If the expected move, if the VIX shouldn't be at 15.51 and the expected move over the next 30 days should not be 108, which is equal to about 4.44%, it would not be. It would just not be. And the cool thing is, so let's extrapolate this out a little bit more. So right now, based off a 15.51 VIX, the 30-day expected move is about $108. But what if the VIX was, let's say, 25? Everything changes. So all of a sudden we have about a 7% expected move. What if the VIX was like it was back in 2008 and it was freaking 80, right? So you'd have a 23% expected move in 30 days. That's some gnarly stuff. If you guys remember, in October of 2008, the market was down 22% in about 2 weeks. So that's some crazy stuff. So this is what's so exciting about this, guys. This is what's so exciting about this. We want price. Great. This is what's so exciting about this is that there's no guessing here. Remember, we're building off of everything that we've built off of before. So remember, price is random. The reason price is random is because we cannot come up with an actual forward earnings, and the risk-free rate of return is 0. Because of that, price is random. It's a 50-50 bet to buy a stock or just sell a stock outright, because again, there's no padding added to stocks anymore. It's not the old days where there was a real positive risk-free rate of return. Right now that it's 0, there's nothing, right? And because of that, we can see price movement as a normal distribution curve, and that normal distribution curve says 68.2% of all random occurrences will fall within the expected move. Volatility is the expected move. So right? And remember, we were trying to find the delta option that tells us how to find the expected move. Here's another way to find it. This is what's so cool. The expected move as we stand here today, now it changes all day, every day, but we stand here today, the expected move in the S&P 500 in the next 30 days based off of a $2,441.32 S&P price and a 15.51 VIX over the next 30 days, the expected move is $108, which is about 4.44%. So if you don't believe that this strategy is wait, I got a really cool one for you guys right here. Let's see what 365 is. 365. Wait, guys, wait for it. So if a 15.51 VIX, this is what's so cool. A 15.51 VIX over 365 days is about $378 is the expected move. What is that? 15.51%. Come on, give me a break. You can't make this stuff up again. This is math. This is pure math. This is why it's not a zero-sum game, guys. This is why it's not a zero-sum game. So if you want to find out what the expected move is in the S&P 500, look no further than the VIX. The VIX is just the expected move over the course of the next year for the S&P 500. Remember, we have all this stuff there. All right? In order to find that, we take the price of the current S&P 500 times the VIX times the square root of how many days we're interested in over 365, right? Let's say over the next 100 days, right? About an 8% expected move. That's about $200, right? Guys, this is some serious stuff. So now you have reasonable expectations. Let's say, for example, you owned so you can't own S&P 500 stock. You can only own options. So what I'm going to do is I'm going to change this up real quick, and I'm going to change it to SPY. So SPY is just the S&P 500 index ETF. You can buy shares. So let's say you own 100 shares of SPY. So equals times 100, right? So and you have $24,412 invested right now in SPY because you owned 100 shares. Now we're going to have some reasonable expectations. You might be sitting there at night going, oh my God, I'm going to lose all this money. Like, I'm going to lose all this money. You know, like, stuff's going on with China, stuff's going on with this and this. Like, I'm going to lose all this, like, this money. This is like crazy stuff. I'm going to lose all this money. Well, as it stands today, the market, again, the VIX is not only the 1-year expected move in the S&P 500, but it's also the 1-year expected move in SPY. So the VIX is saying, and the market is collectively saying, and again, if the market was wrong, this price wouldn't be like this. It would not be a 15.51 VIX. So the market is saying, okay, in the next 20 days, we expect the market to go up or down about $8.86, right? So here's the cool thing. Now we have reasonable expectations about that. So what I just did is I took the expected move for the 20-day period and I multiplied it by 100 because I own 100 shares, right? Because I own 100 shares. So what the market is saying is in the next 20 days, we project, and again, if this was wrong, it wouldn't be 15.51, but we project that the SPY can go up or down about $8.86, give or take a little bit. So now I can go to bed at night going, the worst case scenario, according to what the market thinks over the next 20 days, is I lose $886, which is only 3.63% of my portfolio. That is amazing stuff, guys. That gets me excited. That doesn't get you excited. You have to watch this again or you have to get a pulse. I don't know what to tell you. Now you have reasonable expectations. It's not a guess. The market cannot predict price going up or down because it's random. However, the market can predict what they think the magnitude of the move is going to be, and that's exactly what volatility is. And that's what's so freaking amazing. So let's go through this like a bunch more, guys. This is really, really important. I'm going to go back to the SPX. No, I'll keep it at the SPY. This is so great. So let's say we owned 100 shares, right? And right now the VIX is at 15.5. Let's say over the next 365 days, how much money we can expect or lose based off of how everything is priced today. We can expect to lose about $3,700, which again is 15.51% of our portfolio. How about the next 2 years? What is 365 times 2? That is 730. Great. So what about the next 2 years, right? About $5,000, which again is only 22% of the portfolio. So if you got the heebie-jeebies, if you're freaking out about, oh my God, I'm going to lose all this money, the market is telling you stop and relax. And I'm telling you to chill out because there are reasonable expectations on this. Remember, there are trillions and trillions of dollars every single day bet on this. Are you telling me that trillions and trillions and trillions of dollars have no idea what the fuck they're talking about? No, absolutely not. So again, guys, this is so amazing. This is so crazy. You want to know why everything got really nasty in 2008? So let's say 30 days and let's go to VIX of 80, right? The reason it got so nasty is because you could have lost 23% in a 30-day period, and that was expected. And that was expected to happen. That's why it's so nasty. You know, that's why having an expected move so big is so crazy. Now, people typically equate the VIX and you know, all this stuff to downside risk. However, the market can go up this much. That's totally priced in, guys. You saw when we looked at a normal distribution curve and standard deviation and the expected move of having a 16 delta call and a 16 delta put. You saw this, guys. I mean, you saw this firsthand. So again, really powerful stuff. Now, a lot of you are probably saying, well, Steven, like, this is great. Like, now I have reasonable expectations. Now I have reasonable expectations for how far a stock can move, how far the S&P 500 can move up or down because I have the VIX. But what about every other stock? Well, sit back, guys. Sit back and relax because it's true. It is true that stocks have their own volatility indexes. How about that? And you know what? Let's go show you exactly how to do that. I'm going to log into my TD Ameritrade account here real quick. All right, so I'm in the Thinkorswim platform. Sorry, I had to like uninstall, then reinstall, and now I'm not even used to the way this is all set up. It doesn't have any of my stuff in it, but it doesn't matter, okay? So we were talking about was, again, previously, The VIX is just the 1-year expected move in the S&P 500. That's it, nothing more. It's not the fear index. It's not any of this stuff. It's not this risk on, risk off bullshit. It's nothing more than that. And then a lot of you were probably saying, well, Stephen, like that's great for the S&P 500, but what about for all the other stocks in the world? And then I was just kind of preemptively saying there is a volatility index. It's called implied volatility for every single stock in the world. It's kind of cool. There's a couple ways you can find it, and then you can find out exactly what the expected move for the next 30, 60, 100 days, or however you want is based off of what the market is currently betting on these stocks. Remember, when we look at these stocks to invest and trade in, we want to be in the most liquid products in the world so that we know that these probabilities are the most accurate. So when we talk liquidity, let's talk about Apple. Apple right now, $157 a share and 48 cents. The way to find the implied volatility for a stock in Thinkorswim, I'm in the Analyze tab, Add Simulated Trades. That's where I go, right? We have all the options chains here. What you can do is go to today's options statistics. We're going to scroll down a little bit, and we see right here is implied volatility. Remember, the VIX is the implied volatility or the 1-year expected move in the S&P 500. Apple's implied volatility right now is 26.26%. Stop right now. If you don't know the answer to this question, you have to rewatch this video. What is the 1-year expected move in Apple as everything stands today? It's 26.26%. So let's figure this all out. Let's go back to our little handy dandy Google Sheet. Okay? Oh, it looks like I undid it. So again, the formula to find implied volatility is price times implied volatility times the square root of days over 365, right? So what we have here, let's get the price. And we can get that with Google Sheets as well. So Apple and price. Great. So we can get the price of Apple right now, right? So 157.48, right? Google Sheets is not able to get the implied volatility of individual stocks. So we have to go manually do it. Not the end of the world. And again, we're going to have a lot of tools for you guys where you can just kind of go into one of our lessons here and be able to see this in pretty instant time. We're working on a lot of really cool stuff around this. So let's go back to the platform. We see 26.26%. Right, that's it. And days, let's say 50 days, right? And again, what's the equation? So we take the price and then we multiply it by implied volatility as a percentage, right? So that's why we're doing 26.26 divided by 100. So as a percentage, so 0.2626. And then we're multiplying it by the square root of days divided by 365. This is wrong. There we go. So the current market is saying, that they expect the expected move or the one standard deviation move in Apple that they expect to fall within between 68.2% of the time over the next 50 days with Apple priced at 157.48 and Apple's implied volatility at 26.26. The expected move is up or down $15, right? So let's just move this down one, right? So actually, let's move this over. So up. I don't know what I'm doing here. Up, down, great. And we're going to take the price and we're just going to put it here. Great. So what they're saying is we're going to equals plus the expected move. So Apple can get as high as 172.78 according to the expected move. Again, Apple doesn't have trillions of dollars bet on it, but there's hundreds of billions of dollars bet on it. So again, if the expected move over the course of the next year in Apple wasn't 26.26%, this number would not be accurate. So with that expected move, Apple can go up as high as 172.78 or as low as, let's see, we're going to take the current price minus the expected move. 142.17, right? So get this. Let's say we own 100 shares of Apple, right? So I'm taking the price times 100. Great. So about 15,748 bucks. That's what it costs right now. Now I remember when Apple was like a $500 stock. I was like 50 grand to own 100 shares, but this is a lot easier. Anyway, so right now we're saying the expected move is up 15 bucks or so. So if we own 100 shares, right? We can expect to make somewhere between up or down 1,500 or up or down or down, excuse me, minus, wait, what am I doing here? I'm doing this times 100. No, I'm not even doing that. Let's see here. We want to get the price. So we want to go equals bear with me a second. Okay, let me think this through, guys. Sorry about that. Right? So if Apple goes up to 172, we want to be able to see how much money we can make. So let me just think to here. Quick math. Okay, we'll just figure it out on the fly. So this is going to equal the price times 100. No. Damn it. Right, so we can either make 1,500 bucks or lose 1,500 bucks. Right, so what was this? Equals da-da, da-da-da. Right, or we can either lose. Sorry, I'm gonna hard code this here real quick, guys. I know it's lazy, but I don't know what's happening there. Anyway, so we can make as much as $1,500, or we can lose as much as $1,500. So again, this is reasonable expectation, guys. This is reasonable expectations for stock. Now I want to get this right. Hold on one second. Okay, we're back. Sorry, I was a little a little slow there, but anyway, we got it now. So now this is reasonable expectation, guys. I'm gonna go through this one more time here real quick, and then we're gonna go do this with a ton of stocks because it's so critical that you guys get this. Implied volatility is the 1 year expected move, right? So again, with the VIX, the VIX is not the fear index. The VIX is just the 1 year expected move in the S&P 500. The VIX is nothing more than implied volatility. So every single stock has their own implied volatility. In the Thinkorswim platform, under the Analyze tab, under Add Simulated Trades, we can go down to the bottom, today's option statistics, and get the implied volatility for each stock. Then we can go in now here to now Google Spreadsheet and have reasonable expectations on P&L in any given time frame for every stock in the world. That's how amazing it is. And the more liquid the stock is, remember, liquidity is king. We don't bother with anything that isn't liquid. The more liquid a stock is, the more realistic these numbers are going to be. That's how this is so amazing, guys. And we're going to be in this lesson for a long time. It's very important that you understand this because we're going to blow your mind right after it. So anyway, the price of Apple, $157.48. Right now, the implied volatility is 26.26. Right? Over the next 50 days, based off of the current price of Apple and the current expected move in Apple, the market is projecting Apple to go up or down about $15.30, right? If you own 100 shares of Apple, that means you can expect to make or lose in the next 50 days about $1,500. So that is a big deal, guys. Wall Street will not tell you that. If you get this, I promise you, you're going to be a market hero. I promise you, in a few years, you're going to be a millionaire. No questions asked. I promise you this, guys. I promise you this. This is so exciting. This is so amazing, guys. This is a big deal here. This is a big deal here. So again, what about over the next 100 days in Apple? Over the next 100 days in Apple, we can expect Apple to go up or down about $21, which means we can expect to make on the high end of the range about $2,100 or lose on the low end of the range about $2,100. And the market, remember, the normal distribution curve, the market is expecting that to happen 68.2% of the time because that's the expected move. Again, and the reason it's the expected move is because price is random. Price is random because we cannot predict forward earnings and there is no positive risk-free rate of return. That's why prices are random. So this is so amazing, guys. This is a big deal. Let's go find another stock and we'll just plug it in. I'm going to set this back to 50 days before we go ahead here. So let's go to a big stock that everyone likes, like Amazon. So first thing we're going to do is we're just going to get the price of Amazon. What I'm going to do is I'm going to go to this, and instead of Apple, it's just Amazon. That's all it is. And then we're going to go back and we're going to say, okay, let's remember we're going to the Analyze tab, Add Simulated Trades, and we're going to go down to today's option statistics. Right now, the implied volatility for Amazon is 22.71%. What does that tell us? It tells us over the course of the next year, the market is currently pricing in Amazon to go up or down 22.71%. That's it. So let's go back to our little tool here. What was it? 22.71%? Great. And here we are. Oh, this is wrong. This is supposed to be Amazon. Excuse me. Actually, can I just do this? There we go. And that'll work. Great. So now, if we own 100 shares of Amazon, why is this wrong? Hey, this is a little wrong. Oh, no, that's right. Okay, no, that's right. So if we own 100 shares of Amazon, right, that's going to cost us about 96 grand. Amazon's $967 a share. Where the hell did that come from? Anyway, with $967 a share, the current implied volatility right here, 22.71%. That means there's a 22.17% expected move in Amazon over the course of the next year, right? If we extrapolate that to 50 days, we project Amazon to go up or down about $81 over the course of the next year. And what is that in terms of percentage? Let's see here. So we will take this, divide it by this. We're going to times it by 100. Great. So the expectation is an 8.4% expected move in Amazon the next 50 days, which comes out to up or down about $81, right? So with that being said, again, guys, we have reasonable expectations. The market is betting billions and billions and billions of dollars on this one. So this is no joke here, right? This is absolutely no joke. Actually, I want to add this here real quick. We're doing this on the fly, guys, so bear with me. So I'm moving this here. Great. And then I'm saying percentage move. Awesome. Great. Okay, perfect. This is looking a little bit better. Awesome. So up or down, it can go as high as 1050. It can go as low as 886. You can make or lose about $8,100. That is reasonable expectations on owning 100 shares of Amazon in the next 50 days. That is a big, big, big deal, guys. That's a big, big, big deal. Let's keep going at it. Let's look at a stock that other people like. Facebook. So let's get Facebook in there. FB. FB. You got to change this to FB. I don't know what's happening there. Whatever. I'll figure it out later. Cool. FB. So right now we own 100 shares of Facebook. Let's see. And right now, wow, $168 a share. That's pretty damn good. Again, I'm going to the Analyze Simulated Trades. I'm going down to today's options statistics. I'm going to implied volatility. What does this tell us, guys? It tells us over the next year, the market is currently pricing in an expected move of 24.09% up or down. So let's go add this in here and let's see what it all looks like. So 24.09. Great. So if we own 100 shares, of Facebook right now, we are saying over the next 50 days, Facebook is expected to go up or down about 8.91%, which is about $15. It can go as high as 183, it can go as low as 153, and we can expect to make or lose about $1,500. Guys, this is big stuff. This is reasonable expectations. And again, we're going after the most liquid products in the world to be able to understand this information because the data is dead accurate. The more participation, the more accurate the pricing is, the more perfect the pricing is. Again, Facebook has 151,000 options contracts traded a day, 14 million shares. That's liquidity. These numbers are dead ass accurate. Again, if the expected move over the next 50 days was not up or down about 9% in Facebook, it wouldn't be. Trust me when I say that, because people could make hundreds of billions of dollars if the market was collectively so wrong. Let's keep going, guys. This is super, super important. let's look at Netflix. Netflix. Let's scroll down to today's options statistics. Again, 93,000 options contracts, incredible liquidity. We can trust these numbers to a T. So let's go back to here. We want to add in Netflix, NFLX. Great. Go down here, do the same thing. NFLX. Cool. Okay, so right now we have an implied volatility of 33.36%. What does that say? That says over the course of the next year, the market is pricing in a 33.36% expected move in Netflix. And what does that actually come out to? Let's see. So 33.36, right? Yeah. Okay, great. Over the next 50 days, the market, based off of a current price of 171.4, wow, good for Netflix. Jeez. And an implied volatility of 33.36 over the next 50 days, the market is projecting Netflix to go up or down about 12.34%, which equates to about 21 bucks. So it can go as high as 192, as low as 150, and if you own 100 shares of Netflix, you can expect the expected move, which according to the market should happen about 68.2% of the time, is about up or down $2,100. This is a big deal, guys. If you don't get this, you need to watch this a million times till you understand it. This is a big, big deal. Now you have reasonable expectations about all this stuff. So here's a really, really cool one, guys. Here's the cool one. Actually, we're gonna go through a couple more, and then I'm gonna show you the really cool one. But we're gonna go through a couple more right now. Give me 1 second. Let me just figure out exactly what right one to do here. Okay, great. So let's look at some more. So what are some other popular stocks? Let's say Snapchat. Funky, Snapchat. Great. Fun. This is going to be a good one. So Snapchat obviously has a ton of liquidity, guys. 84 million shares, about 264,000 options contracts traded today. These numbers are going to be dead accurate. So let's see if Google Sheets even pulls up Snap. I've never even tried it on this. Do we have Snap? We have Snap. Okay. There's to you, social media. Snap. Great. Currently, the implied volatility, this is a fun one. Currently, the implied volatility for Snapchat, the expected move over the next course of the year is 74.25%. So this is a fun one here. This is a big one. 0.25%. Great. Cool. In the next 50 days, based off the current price of Snapchat, based off of the 1 year expected move, which is the implied volatility of Snapchat, over the next 50 days, the market is currently predicting up or down about 27.5%, which equates to about $3.25, right? It's only an $11 stock. So it can go as high as 15 bucks, it can go as low as 8.5, and you can make or lose about $320. So the cool thing is, let's look at Snapchat here. Everyone's like, oh my God, Snapchat going to the moon, like this and that, this and that. Remember where the expected move is over the next 50 days. Let's do this. Let's do this chart setting here. So time frames, no. Appearance, time access, expansion to 50 bars. Cool. Great. So this is the next 50 days. And based on our calculations, we think it can go as high as 15. So let's go to drawings, price level, as high as 15. Great. And as low as 8.5. So we're going to have to make this a little bit smaller. 8.5. And we go. So this here is currently telling us that within 15 to 8.5, in the next 50 days, which we extrapolated this chart out to be, this is where the market projects Snapchat to settle within that time frame, within 50 days. Again, this is the one standard deviation move or the expected move. This is some really powerful stuff. So a lot of you, if you guys are holding Snapchat stock right now at $11.83, and you're like, well, shit, I think Snapchat is going to go up to like 25 bucks. I got news for you guys. In the next 50 days, it can go as high as 15. According to the market. Now, the market could be wrong, but it's usually right. Let's do 200 days. The market only thinks it can get as high as 18. Remember, you're like, oh, it can go up to 25. So let's see, 300 days. No. 600 days. 730 days. So great. Here we go. 730 days. the market believes, only in 2 years from now does the market believe that Snapchat can have a chance to get up to your, 25 strike. To your 25 strike, guys. That's a big deal. That has reasonable expectations. So if Snapchat goes up a little bit, let's say Snapchat goes up to 15, right, in 30 days. That's a great time to start trimming some of your gains. That's a really great time to start getting out of your position because because again, that's the reasonable expectations. The market doesn't think that Snapchat can go any further. That's just so crazy. So I want to go back to the SPX here because this is a really, really fun one for me. So the SPX, again, the S&P 500 is the biggest index in the world, and this is a really fun one, and I promise I'll stop venting after this, but this is a fun one. The S&P 500 is the biggest index in the world, and remember, at the end of every single year, all these big firms, all these big banks send their top analysts out there and they say, guys, go give me a price projection based off of what the S&P 500 can do in the next year. And we're going to go out there and we're going to sell that data to all of our clients and all these people that have so much money that they literally buy this shit for like a couple $100 million, right? But we're going to be able to do those projections right now in about 2 seconds. So we already showed you how to do it with the 16 delta. Now here's another way. So we want to get the price of the VIX. So equals, because again, remember, the VIX is the expected move in the S&P 500 for the next year. So shit, what else is there? So right now, as it stands today, with a 15.51 VIX over the next year, the market is projecting the S&P 500 to go up or down 15.51%, which is about 378 points. So over the course of the next year, we project that the market is projecting, not me, the market is literally screaming, and they're projecting, hey, we think the market can get as high as about 2,800 and as low as about 2,060. There it is. So there's no need for any of the other garbage. All right, we just learned a lot. I'm getting a little bit ahead of myself. Let me just go through this stuff one more time because it is super, super important. So again, what is volatility, guys? Volatility is just a 1 year expected move. The VIX itself is the 1 year expected move in the S&P 500. That's all it is. And the way we find out, we just take the price times implied volatility times the square root of how many days over 365 that we're interested to. And again, we're doing it over 365 is because implied volatility is the 1 year expected move. So that's the S&P 500, but we can find that for stocks too. And the way we find that is in the Thinkorswim platform, we go to Add Simulated Trades in the Analyze tab, today's option statistics, and we find the implied volatility, right? Pretty cool. So what about for stocks, right? Stocks have their own volatility index. That's the cool thing. So here we are now, guys. We have a spoiler for what's to come. I was thinking about telling you guys this. I was considering not doing it, but now I'm going to do it. Volatility is the only mean reverting asset, period. So price does not revert to the mean. It doesn't. Volatility is the only asset that reverts to the mean. When volatility is high, it comes down. When volatility is low, it comes up. Now the truth is, it takes 4 times as long for volatility to come up to the average when it's below than it does when compared to being above the average to the average. So let me repeat that. When volatility is low, it takes 4 times as long to get up to the average as when compared to volatility is high, coming back down to the average. So this is a little spoiler to whet your beak a little bit for what we're going to be learning here in the future, but this is the beginning of turning you into a serious, serious investor, a $1 million trader, a true market hero. So I know this was a lot. If you need to watch this a few times, no problem. These are yours to keep. Just guys, this is a big, big deal now. Now we have reasonable expectations on this stuff. Now we have reasonable expectations on this stuff. Let's do one more. Let's do one more because I'm so excited about this. Let's think of a stock that's out there that people talk about all the time. Google. Great. So Google, the largest search engine in the world, all that fun stuff. GOOGL is the symbol. GOOGL is the symbol. Great. So how we find it, we go to the Analyze tab, Add Simulated Trades, we go down to the today's option statistics, and we have implied volatility of 20.38. Great, we're going to add it in here. 20.38. Great. Over the next 50 days, the market is saying Google can go up or down about 7.5%, which is about $70. It can go up to about 1,000, down to 860. Boom. There you go. Boom. How crazy is that? How crazy is that? So crazy. So now that we all know this, I'm going to give you guys a little bit of a trick. This is a fun one. So remember, implied volatility is the market's expectation of a stock over the next year. But obviously that gets extrapolated down to any days that we want, right? So we can find out for 50 days here, or we can find out for 10 days, right? So with a 20.38 VIX, or implied volatility for Google, and a $30 stock, the market is projecting the next 10 days that Google goes up or down about 3.37%, which is about $31. It can go as high as 961 or as low as about 900. Right? So when we're looking at implied volatility, what if we're not interested in that many days? What if we're just interested in today, for example? What if we're just interested in today? Well, there's a little bit of a hint. Actually, a 19.1% implied volatility gives you a 1-day expected move. So now we're getting a little funky here. Now this is like really cool. So we see this. We have a price of 930. We have an implied volatility of 19.1 for 1 day, right? For 1 day. The expected move for that 1 day is 1%, right? So if the VIX, if the implied volatility for Google is ever 19.1%, and we're concerned about how high or how low it can go, or any stock for that matter, it's just 1%. So it can go up or down about $9.30. That's it. So that's really cool. And so again, guys, we learned a lot here. This is a little bonus thing I threw in at the end, but I will see you on the next video, and I promise you the next video is going to scare the shit out of you. It's going to be so great.